Thanks everyone for joining. My name is Brittany Melville. I'm the Director of Marketing and Sales with Next Generation. We're going to talk about self-directed IRA as a powerful tool for making real estate investments with tax benefits. As it relates to our role, we are a financial institution that assists investors with opening new self-directed IRAs, getting them funded, and making the investment transactions that they'd like to make. We are not a bank or financial planner or financial advisors, but as a custodian and administrator, we provide all the tax reporting on these self-directed IRAs, and we do all the record keeping as well as the transaction processing, and provide, of course, lots of education. That's really our goal, to make sure that individuals are feeling confident to do this successfully. As I mentioned, we're not financial advisors, so as a disclaimer, we're not fiduciaries, and that just means that we do not sell any specific investment products. We also don't review investments for legality or endorse specific investments. We provide education around the regulations that work within self-directed IRAs, but we do not provide financial advice. So it's typically on the investors themselves to do that due diligence and be comfortable with the investments that they're choosing. Just by way of quick background on the company, we're a women-owned business based in northern New Jersey in Essex County. We've been in business about 16 years, and we were founded by Jamie Raskolniks, who is still our CEO. She is a real estate broker licensed in New Jersey and also owns a property management company, and founded this organization out of her desire to put her own real estate investments in a retirement account. So became very passionate about this strategy for wealth building and wanted to share it with others. So she founded Next Generation. And we've continued to contribute lots of content to lots of media outlets, as well as Forbes, where we do some writing on the Finance Council there. So for those who aren't familiar and may have heard about this by word of mouth, or maybe have never heard of this, what is a self-directed IRA? It's not the type of IRA that you typically would see with Fidelity or Schwab or Morgan Stanley, for example. Those are typically going to limit your allowable options to invest in stocks, bonds, mutual funds, and anything that's publicly traded. When we talk about self-directed, truly self-directed IRAs, we're talking about those that allow you to invest in non-publicly traded, what we call alternative assets, like real estate, for example. The benefits of doing that, well, there are a few. So one is when you use your retirement account as a vehicle to make an investment in something like real estate, and then you earn a return on your investment, that return is going to go back into your retirement account and be tax sheltered, meaning that you're not responsible for paying tax on the earnings as long as it's held in your retirement account. So you're sheltering those gains. As well, it can provide a hedge against stock market volatility. So we've seen the market go up and down over the years. Last year, we had a scare there as well during the pandemic. So with alternative assets versus publicly traded assets, tend to see more stable returns over time. So by diversifying beyond stocks, bonds, et cetera, and including alternatives in a portfolio, it can tend to stabilize overall returns, just generally speaking. Additionally, another benefit is having the ability to choose your own investments and have more freedom over your return on investment. So if you already invest in real estate, or you're interested in investing in real estate, you have an idea of what types of returns you're typically getting on your deals. If you could apply those to your retirement account and get those level of returns, you could potentially see much higher returns than what you're getting in the stock market. And of course, you have more control over the choices you're making if you're choosing your own investments, like picking out a property, for example, negotiating price, versus just buying stock and then hoping that the company does well and not really having much say in whether that happens or not. So one of the reasons that this is becoming important is because the retirement landscape is changing. And we're seeing that a lot of Americans of retirement age are continuing to stay in the workforce, 20% actually, which is a large portion. And those levels haven't been that high for quite some time. So it could be a combination of things, but we're starting to see that A lot of Americans do not have enough money saved to comfortably retire, so they're forced to continue to work. We don't have enough in Social Security to rely on as a sole source. We don't have as many of the old traditional pension plans and other types of qualified plans that would offer lifetime payouts. So we're relying on just our IRAs and our 401ks to kind of save up. So if we are trying to increase our return on investment in those accounts so that we can accelerate that wealth building, the onus is more so now being put on us to make those decisions. So that's where self-direction can come into play, and having more control can potentially benefit. In terms of self-directed IRA types, you could choose from a traditional tax-deferred IRA, a Roth IRA, which is actually going to offer you tax-free earnings as they grow. If you are a real estate agent, or you own your own business, or you're a contractor, if you're paid on a 1099, you can open a SEP IRA, simple, or other type of employer plan. These are designed for business owners, and they allow you to put in more money out of pocket to stash away into these accounts and start to build that value over time. And of course, you can invest any of these accounts into real estate, private equity, some of the other things we're going to talk about. Lastly, the last two here are not retirement accounts, but also have some tax benefits. To save for a child's education, ESAs, education savings accounts, allow for tax-free withdrawals if the funds are going to be used for education expenses. These can be self-directed, invested into things like real estate, and the same with HSAs, health savings accounts, tax-free withdrawals for medical expenses. So ways to get funds into a self-directed IRA, you have a few options. So let's say you establish a new account and you want to take money out of pocket and put into your IRA. You can make a personal contribution, and those annual limits are set by the IRS, depending on what type of IRA you have. For example, if you have a traditional IRA, it's $6,000 per year or $7,000 per year if you're over the age of 50. If you have a SEP and you're a business owner, it's a percentage of your compensation from the business, up to 25%, which maxes out at $58,000 per year. So there's a lot of potential for you if you don't have a retirement account, or you want to start building up that balance. You can start to take money out of your business and put it in, and there could be some tax benefits to doing that as well. If you have existing IRAs or an IRA, you can transfer funds from an existing account, like with a Fidelity, for example. If they say that they won't hold real estate for you, you can transfer some of that into a self-directed IRA. Not a reportable event, not a taxable event. There's no penalty for doing that. You're not limited to the amount of transfers that you can do. If you have an old 401k, if you've left corporate America and you're now a business owner, and you have a 401k that's just sitting there and not doing anything, you can roll those funds into a self-directed IRA and more actively invest those. And you can also move funds from a tax-deferred account, like a traditional IRA, for example, to a Roth, which I had mentioned is that tax-free earning. But in the process of doing that, it creates a taxable event for that year, and then all your earnings would grow tax-free. That's called a conversion. So you can see there are a few different ways that you can get cash into a self-directed IRA to start investing. So of course, we know that real estate can be included in IRAs. You can see all these things here. There are tons of things: hedge funds, partnerships, mortgage notes, private lending, cryptocurrency, impact investing, private equity, pre-IPO stock. The list goes on. The IRS really only restricts two categories, which are life insurance. So if you can think of anything that's not life insurance and collectibles and it's not publicly traded, likely it can be held in an IRA. So just for clarification, because we get these questions a lot. So what happens when I put money in a self-directed IRA and then I want to make an investment? Do I pull it out? Why wouldn't I be taxed if I do that? So essentially what happens is the custodian, which is the company that holds your self-directed IRA, is going to be the one to handle the funds for you. Now, they're not going to make any decisions on the investments. You're going to make the decisions, and you're going to direct that custodian on behalf of your account to take the funds and invest them into products. And then when those investments yield return, the return would flow back directly to the custodian and be deposited back into your IRA, thus giving you those tax advantages and keeping it tax sheltered. So just a point of clarification that you're not physically taking the funds out to invest them. You're investing through the IRA as the vehicle, which is technically going to be the investor listed on any documentation if you wanted to go this route. So one way that you can think about self-directed IRAs, I'm going to talk about 3 different approaches real quick. One is to leverage other people's self-directed IRAs as a source of funding. So whether or not you want your own, let's say that you are raising money for a project, for a deal, and you're looking for partners, or you're just looking for equity investors. You can ask individuals that you're speaking with if they have money in the retirement accounts that they would be interested in investing with you. It might be that they don't have enough in the bank, or maybe they're not comfortable taking that much money out of their checking or savings to invest with you, but they have a lot of money in an IRA or 401k, and they're comfortable doing that. You can accept that as sort of an equity investment. You can partner with those individuals and their IRAs to purchase properties. You could borrow funds from those IRAs so that the IRA would sort of be like a private lender. And then you would pay back the IRA principal and interest, or whatever it's getting back in line with the terms you agree on. So here you can see that it's not just about utilizing your own self-directed IRAs, but understanding that there's a ton of money tied up in retirement accounts, about $19 trillion out there, and a very, very large portion of it still in the stock market. But that doesn't mean that it couldn't be directed into some other private investments if the conversations are being had. So the second approach is, we talked about private lending rather than borrowing from an IRA, using an IRA to lend money out to another individual or an entity. These loans can be, or these notes can be secured or unsecured. They can be secured by property or other collateral. And then of course, if an IRA is the lender, the IRA's return on investment is that principal and interest. And if you think about it, if you're getting just, for example, 10%, if you have a 10% interest rate on this loan, 10% return on your investment, pretty decent when you think about that over a period of time for a passive investment, especially when you look at returns in the market over longer periods of time. So the other way to utilize the self-directed IRA is to directly purchase property or an asset of some sort, whether it's raw land and you'd want to develop on it, you want to purchase single family, multifamily, commercial real estate. You can buy and hold that real estate in your IRA and collect rental income, tax advantaged, or you can fix and flip that property, sell it, and then take the gains back into your IRA. Those properties can be purchased outright if there's enough cash in the IRA, or if multiple IRAs are partnering together, sort of like a syndication or limited partnership, that can be done as well. If financing is needed, it's an option, but the IRA would be required to take a non-recourse loan, which basically just means that the lender's only recourse if the IRA defaults is the property. So they would only be able to foreclose on the property that's leveraged, not to take any other assets from the IRA or the individual. So the loan couldn't be personally guaranteed. So it tend to be a little bit more restrictive. There are banks that offer these to IRAs. It is definitely an option. But again, another option is to partner up if there's not sufficient cash. I do see something in the chat, and I just want to make sure that everyone can hear me. Okay. Yes. And please, if you can't hear me or I'm cutting out, please let me know. Okay, we're still good. Okay, so we talked about partnering, and I'm moving through this a little quickly because we have a limited amount of time. But next we're going to talk about prohibited transactions. So there's a lot of exciting stuff that you can do, as you can see, but we also do want to be mindful of the fact that this is regulated by the IRS, and the IRS does have rules and some restrictions and regulations around how IRAs can invest. So these restrictions, they call prohibited transactions, and they basically defined it as a transaction between an IRA and what they call a disqualified person, which means you cannot use your IRA to transact with that person. So I'm going to skip ahead real quick and tell you disqualified persons would include, for example, if you had your own self-directed IRA, you would personally be disqualified from doing a direct transaction with your IRA. Same thing would go for any spouse, ascendants, descendants, or their spouses. So if you think about your family tree in an up and down direction, those relationships would be considered disqualified persons. For some reason, the side-to-side relationships are not disqualified, so that you could actually invest with people like siblings, cousins, aunts, and uncles. So those are options. Additionally, you would be restricted from having the IRA transact with any company or professional providing a service to the account. So that could include a tax advisor, CPA, financial advisor, or attorney. Any company that is majority owned by a combination of these relationships. So really you want to think about what is the benefit or what is the purpose of doing this investment? If you're trying to benefit yourself personally and get quick cash tomorrow, then using your IRA isn't going to be the right play for that objective. This is more of a passive investment, long-term solution for your financial planning. So you're thinking about when I retire and I decide I no longer want to work and I want to have a margarita on the beach, what am I going to have to live off of? Or thinking about your children or family members that you might want to leave something to, and wealth building for future generations. Again, that's something that you would be thinking about here. So if we go back and we look back at the prohibited transactions, an example of, I'll give you some examples of prohibited transactions might be someone trying to utilize their IRA to purchase property that is already owned by their parents or themselves. Let's say somebody owns a property and they want to transfer it into their IRA. Unfortunately, if you already own it, because you're a disqualified person from your IRA, you can't sell it to your IRA. Same thing if you wanted to try to sell a property from your IRA to one of your children. You wouldn't be allowed to do that. Same thing goes with extending credit. So when we're lending to and from the IRA, that can't be in exchange with a disqualified person. It would have to be a non-disqualified person. So an unrelated individual or any of the individuals that do not fall on that list be looked at. And then self-dealing is sort of more of a gray area. It can start to get a little complex. Usually this comes down to a determination that's made by the IRA custodian, like Next Generation, for example, as to whether they can hold the investment. Or if it starts to get really complex, an attorney sometimes might make a determination whether this is prohibited or not. But an example of something like this might be someone invests into a private company with their IRA and they don't have majority ownership of the company. So that's good, right? They don't personally have any ownership, nor do any disqualified people, but they're also providing consulting services to the company as a person themselves, and they're getting paid commissions and getting paid personally from the company's performance. Now that could potentially be a problem because the IRA is investing in the company, so the IRA is getting a return, and then that IRA holder is also personally getting paid for services that they're providing separately. So it's sort of like a double benefit. So these are some things to think about when you're looking at real estate or any investment with a self-directed IRA. What are some things that you're trying to accomplish, and do they fall within the allowable guidelines? So some more specific examples of prohibited transactions when we look at real estate, to kind of put this in perspective, would be understanding that if, for example, your IRA purchases property and it's 100% owner of that property, then the IRA is 100% responsible for maintenance, repairs, expenses, as well as it's 100% entitled to all of the income that's generated from that investment. Additionally, when we look at providing or doing repairs, there is no sweat equity allowed on a property by any disqualified person in this case. So going in and trying to fix like plumbing and that sort of thing, that would have to be done by either a property management company, contractor, or a non-disqualified or unrelated person to you, for example, if your IRA owns the property. Same thing with letting people use the property or rent it or live in it. You are not permitted to have any disqualified people live in it, rent it out. Of course, if your IRA owns a property, you're still able to manage it from collecting rent, screening tenants, doing the, working on the lease agreement with them. All of that you can still do, and you can still visit the property and oversee it. You can assess it. Of course, you're still managing it, but you're just not contributing personal value to it yourself. And then the last one that we see a lot is where there's confusion is you need to make sure if you want to buy a property with an IRA or get into an investment that everything is done from the outset through the IRA. So contract is signed in the name of the IRA, deposit is put down through the IRA, and then of course the property would be deeded to the IRA as well. But a lot of times what will happen is investor will call and say, I found a property, I put down a deposit, I'm going through the steps, I want to set up an IRA and have my IRA buy it. By that point, it's too late because you personally gotten involved and given your IRA now an advantage to purchase the property. So these are just things to be aware of in advance and think about. I know it's a lot of information. This typically isn't something that is going to make 100% sense in one session. So typically there's sort of an educational journey to go through to fully understand all this and be comfortable enough to say, this makes sense for me. I feel confident in what I'm expected to do and my responsibility and role using the account, and I want to do it. And then of course, at that point, what would happen is if you wanted to get started, you would fill out an application to establish an account. Typically would take 1 to 2 business days. Fund your account through one of the methods that we described, transfer, rollover, contribution, or a combination of those things. Working with the custodian to get that done. The custodian would guide you through the steps, and there's forms that you would need to fill out to make that happen. We've seen that happen in as few as few days or a week or 2, usually. The only reason we have such conservative estimate on this is because we rely on factors that we don't have control over, which is the other institution holding your money to move it out and to let it go. Now, the more everybody works together, typically the more streamlined that process will be. But that would be the next step in the process after setting up the accounts, getting the cash in there. And then of course, lastly, you're going to make your investment. So once you identify the deal that you want to do or the asset you want to purchase with your IRA, you are going to let your custodian know, and then they're going to request certain documentation from you. It's going to include a direction of investment letter. So you're going to let that custodian know, I want my IRA to invest in, for example, ABC property on 123 Main Street. Here's the price we've agreed on, closing agents, contact information. You'll still do your title search and all that. Do your due diligence as you normally would on the deal, but you're going to let your custodian know, deposit has to be paid to this account and this much. Same thing for closing, instructions, sending the funds out and how you want them to be sent out. So the custodian is involved in all that with you so that they can be executing these directions from you while you're still making the decisions. It's also going to be necessary that you require supporting documentation. So for example, if it is a real estate purchase direct, it's going to be, we'll want to see the purchase agreement, the contract, anything else any other paperwork that would need to be signed. If you're lending, it would need to be a copy of the promissory note. So let's see the note, who is the borrower. We're looking at things like, is the IRA labeled appropriately as a lender on the document? We'll let you know how that needs to be labeled, but we're looking to make sure that it's accurate prior to processing any transaction, because essentially our number one goal is making sure that everything's documented correctly. Nothing is being done that's going to create a taxable event for the IRA, because if that's what you wanted, you wouldn't be doing it through your IRA. And keeping the tax advantage status of that account. So that's really the goal. That review process on all the supporting and internal documentation is about a 2 to 5 business day turnaround. And then the transaction would be processed. And then any other payments that need to be made out of the IRA for any reason associated with the investment, authorize them through the custodian. The custodian will pay them. Same thing with funds coming back in. Rent, for example, rental income, rent checks made out to the IRA. Or if you're using an LLC to purchase the property through your IRA, and I should have touched on this earlier, but your IRA could basically fund a newly created LLC, and then that LLC owned by the IRA could purchase property. So that's also an option. So all in all, we typically say conservatively give it like 4 to 6 weeks to get, if you've never opened up an account and done anything like this, it is a bit of a learning curve just to get started the first time around. And it can't hurt to open the account in advance if you anticipate an investment coming up, because there's no minimum required to open and there's no time period by which you have to fund the account. Of course, it makes sense to have something in the works or something at least on the horizon several months out. But having the account set up and ready to go will just give you a leg up on being ready to make that move when you do see a deal come. We know real estate deals move quickly. So with that, hopefully this has been valuable. How am I on time? Oh, we're doing okay. Hopefully this has been valuable. And I just want to reiterate that if you're interested in real estate or you have experience in real estate already, then understanding that this is out there and just having this level of education can be very beneficial in terms of having conversations with people to better understand the funds that investors have to work with, and realizing that they might have more than you think they have to work with you. And then, of course, if you wanted them to speak with somebody, connect them with a resource like an IRA custodian that can further educate them and help, set things up and get things going. So I want to thank everybody for their time. I know I kind of flew through that. So as I mentioned before, if you wanted to discuss anything further, our website is here, and this email will go to my team. You can call the office, and we're on all social media. The website does have a ton of information you can download. There's a whole webinar library on demand that covers different investment options. There are white papers. There's a chat feature on the site. So there's a ton of ways to get connected and get educated, and we hope to be able to provide more value through that as well.
Hey, Brittany, we got a little more time. Were you able to answer the questions with William Schwartz?
No, I actually haven't looked at them yet, so we can.
Okay, let's answer these questions because we do have a little more time. All right, the first question is, can a real estate partnership interest be used as an annual contribution to a traditional IRA?
So annual contributions can be in the form of cash only. So as long as, so it depends on if you plan to make a cash contribution, then yes. Like if you were going to liquidate that interest into cash and do it, yes. If not, then no. And as long as you have income, you can make contributions up to the limit that the IRS would allow. So for the traditional, it would be $6,000 per year or $7,000 if you're over the age of 50. And then you, of course, you have the ability to make a prior year contribution if you've missed the deadline. You have until, for example, if you wanted to make a contribution for the year 2020, you have until the now May 17th filing deadline to do that. Hopefully that answers the question.
Hopefully. Gerald, do we make contact with you to be a custodian, our custodian?
So if you wanted to speak with us, you can reach out to me, but the email address here on the screen would be the best. I'm part of that group, so if you email that, newaccounts@nextgenerationtrust.com, I will see it. So it'll either go to me or someone on my team that can help get things started.
I think this next answer is no, but do you do non-recourse loans or do you have a source?
That's a good question. So we personally don't. However, there are 2 banks that we are aware of that clients have used for non-recourse loans, and they're listed on our website actually. Or if you want to reach out to me directly, I'm happy to link you to the information. But they are on our website under professional resources. We there have a list of non-recourse lenders. We also have a list of some different investment resources, and we also have a list of attorneys that work with self-directed IRAs as well. They're not necessarily affiliated with us in any way, but just that we know our clients have worked with them and that we've spoken with them over the years, and we know that they have experience in this field.
Gerald was asking, does he get a copy of the slideshow? Slide
Sure.
deck.
Yeah, so what we'll actually do, and I know this is being recorded as well. So what we will do is once we have access to the recording, for anyone who attended, we will send out an email. It might be a couple days, so just bear with us, but we'll send out an email with the recording and then a link as well to a copy of this. Absolutely.
And you got another question here. What is the max cash limit contribution to go into a self-directed IRA with the catch-up contribution eligibility past the age of 55?
So again, it's the catch-ups are dependent on the type of account that you have, the type of IRA that you have. And they're the same for regular IRAs as they are for self-directed IRAs. So they're all determined by the IRS. I can tell you that I know for traditional and Roth IRAs, typically the catch-up is an additional $1,000 per year. So for example, with a traditional, typically you'd be able to max out at $6,000 per year. With if you're over the age of 50, you can put in an additional $1,000, so that enable you to do $7,000 per year. It's typically the same with a Roth. However, the Roths can have additional limitations based on your adjusted gross income. So the best way, without getting into too much of the weeds here, the best way for you to see that is to go to irs.gov and search for contribution limits there, or you can Google, but make sure you're going to the IRS website and not somewhere else. Make sure it's a credible source. And they actually have, by account type, they have charts. So they'll let you know exactly for 2021, what are the contribution limits and what are the catch-up amounts. And it's for the catch-up amounts are for individuals over the age of 50.
Okay, that's very good, Brittany. And then there was another question, such great information. Will this webinar be available for reviewing afterwards? And the answer is yes. Again, we will be sending over all of the attendees' names to Brittany. She will be sending out a thank you letter, and you can continue asking Brittany for more questions and ask her for the slideshows and the videos. She will get a copy of the video as well. So again, allow us a little time to do all the editing of all the videos, and also we will get this over to her. And by all means, stay in touch, keep on reaching out to her. She will email you all her information, her contact information. So, and once again, Brittany, I really want to thank you for coming out. Brittany's company, Next Generation, is also a client of ours, where we also put out beautiful monthly webinars, and she will be back. And we will also make sure that everybody that did attend this webinar will get a copy of that invite of her next webinar session with her great panels. I guess your panelists, I'm not sure who they're going to be, but it's going to be exciting. Brittany, thank you so much. Thank you.
Thank you. Thanks everyone for your time. I hope you enjoy the rest of the expo.
Definitely, and I want to thank everybody, and we'll see you soon for our next session. Everybody, take care.
Take care.
Bye-bye, Brittany.